Hello, I'm Tyler Rudek, Chief Investment Officer at Boyum Wealth Architects. The first half of 2026 gave investors plenty to digest. Conflict in the Middle East, higher oil prices, inflation concerns, and Fed uncertainty, and questions around artificial intelligence. And yet, markets reached new all-time highs, earnings continue to grow, and diversified portfolios were rewarded. This week, I'll walk through 5 charts that highlight key investor lessons for the second half of this year. Chart 1 looks at U.S. business cycles dating back to World War II. The current business cycle began in April of 2020 and has now entered its 7th year. Despite inflation, tariffs, and geopolitical shocks, the economy has remained resilient. Historically, business cycles can last much longer than investors expect. A healthy economy supports consumer spending, business investment, corporate earnings, and ultimately long-term market returns. Next up, we have asset class performance. Many asset classes have performed well so far this year, including U.S. large caps, small caps, emerging markets, and commodities. This is a good reminder that diversification still matters. The second quarter was especially strong, helped by resilient earnings, improving sentiment around the Middle East conflict, and continued enthusiasm around AI. Third, we have Middle East conflicts and markets. Oil prices spiked earlier this year as tensions in Iran raised concerns about energy supply, but prices have since pulled back significantly. That matters because recent inflation pressure has been concentrated in energy. If oil prices remain lower, inflation could ease in the second half of the year. Chart 4 looks at volatility and forward returns. Market volatility has been manageable. The VIX is currently below its long-term average, even after several major macro events. The S&P 500's largest pullback this year has been about 9%, but the market has already recovered and reached multiple new highs. The lesson is that volatility is normal, but reacting emotionally can be costly. And finally, we look at money market funds and interest rates. Money market assets have reached a record $7.9 trillion as investors have held more cash in recent years. Cash can feel safe, especially when yields are higher, but inflation can still erode purchasing power. The challenge is not just getting out of the market, but knowing when to get back in. And that is it for this week. The bottom line is that the first half of 2026 rewarded investors who stayed diversified, stayed invested, and maintained a long-term perspective. As we move into the second half of the year, headlines will continue to shift, but a disciplined financial plan, a balanced portfolio, and patience will remain the best tools for navigating uncertainty. As always, please reach out if you have any questions, and thank you for watching.